Yo, what's up, guys? It's your boy Looney. Today, we're tackling a debate many of us face as this year has provided pretty crazy returns. And that is, should you have cash taking profits or should you stay invested and potentially capture bigger gains? We're going to highlight the possible downside and the importance of holding cash, but also the potential for the massive upside. So we're going to break it down and I'm going to show you how I'm treating cash. But before we get into this video, I do want to do a quick shout out to my Discord. It is free to join. And then I also offer a premium membership that's $8 a month. And that gives you access to one-on-one coaching, trade callouts. I have an option selling course. I do giveaways and more. You can check it out. All the links to that are in the description. So let's first highlight cash versus equity, the pros and cons, because as of now, you can hold cash in a high yield savings account. Robinhood itself has a 4%, and that is pretty good. A 4% annual is very reliable and low volatility return. Although it might change on the brokerage, you could obviously keep it in a CD or savings account. But if we do see those interest rates fall, those returns might shrink. You might have a less of a yield on Robinhood or whatever you use for the high yield savings. So you really do risk being sidelines when the market possibly rallies, because when interest rates cut, the possibility of higher risk like stocks and even crypto, it actually benefits. On the other hand, staying invested, especially in equities or crypto, does let you ride that upside if growth markets push higher, but you need to be ready for those downturns, which can happen fast. So this is actually a perfect day to show you, because today we did see a massive drop in the market and then somehow we ended up green. And I was able to benefit it from holding cash. So let's get into why I believe a mixed approach actually works. So I prefer a hybrid. I do keep cash, but I do treat it like a position. I have enough to feel secure and act when dips come, like we saw today. And I sold some cash secured puts. These are the type of trades I give to my premium members, but I had a lot more cash. I had around 12,000 sitting in cash. And you can see here, I actually am earning interest on 11,000. But my cash or buying power is showing 7,600. And that is because I deployed some cash during this dip. But I didn't go all in. And it's pretty crazy to see that it's actually paying off, because later, just today, we saw green and the market closed green. So I monitor when to deploy my cash based on market signals like VIX and overall sentiment. But let's look at the VIX, because VIX is a volatility index, and it measures volatility or fear in the market. And when there's higher fear, there's more opportunity. When there's lower VIX, less risk, and there's less urgency. I'd say around this $15 on the VIX. That's actually on the lower end. It's sort of the medium. Once you get to the 15, 20, that is sort of where it gets a little bit more volatile. And then anything more than like 20, 25, this is when there's high volatility in the market, high fear, and higher premiums and more opportunity. But lower VIX, anything under like 15, we're sort of seeing that uncertainty cool off and there's less risk. But if you are an investor like myself, sometimes you sort of think that when volatility is low, that the potential for risk is higher. So I'm going to go over my examples once again. We did see a massive dip, or a little bit of a dip, on a red day. I was down about 2%. And even this entire week, I was down. We saw that initial push downwards yesterday, and it followed in to today. So some of my stocks like SoFi, Riot, and Mara were actually hit. And during this dip, I decided to sell puts. And I only chose the ones that were in red positions. So a few of them was Oscar and Mara, mostly Mara. So let's look at Mara. You can see here I'm actually negative on my total return, but my options and my overall return is a little bit higher from selling options. But I saw this massive dip, this massive volatility, and I sold cash secured puts. So I have this $14, I have this $13, and I have a 13.5. And this is actually dollar cost averaging with options, which is a pretty crazy strategy that you can combine. And I wouldn't be able to do this if I was all already in. If I already had my money in a different asset, whether it be a different stock, whether it be this stock or crypto, I wouldn't be able to do this strategy and take advantage of these lower prices. So I was able to have the cash ready, and as it dipped even further, I did lower strike prices and dollar cost average. And not only that, I still have more cash on the sideline. And if we do see more dips, I might even do riskier strategies. So it's very important you hold cash, you treat it like a position. And again, we can look at Oscar is another one. This one is a different scenario. This one, I just wanted to take advantage of collecting premium. And this one wasn't as big of an opportunity as Mara because we could see it is still actually down on the day. But still, I wouldn't mind building a Oscar position at lower prices because if it does drop to 13.5, I'm okay with owning it because I already own it at 14.15, and I do believe in this company long term, and healthcare has been beaten down pretty recently. So we could see here, just by doing that simple strategy of buying the dip, I am actually green as the market closed. So having cash does give you flexibility, but you also want to have some skin in the game in case we do go upwards. Because if we do go upwards, I do miss out on some opportunity, but I am invested. So I have Mara, I have the stocks, I have SoFi. And SoFi, let's look at that one because I didn't sell any cash secured puts despite that dip, and this one I actually recovered as well. But it's because I already have the shares. I already have 400 shares, and my return is pretty good. I have 100% return, and I'm not doing any more investing in SoFi until I see massive volatility. So in short, don't box yourself into cash only or all in investing. A blend is actually the most ideal. You use cash to protect against crashes and strike on dips, or you could buy puts and sort of hedge to the downside. I don't personally do that too often. I do have covered calls that help protect me, but buying puts, you could actually benefit when the market goes downwards, or you could just simply hold cash like I was just saying, but also staying invested enough to grow when markets move up is super important. And you could use indicators like I just showed you, like VIX, to size your deployment and stay strategic. So cash isn't necessarily dead money. It's actually an active tool in your investing toolkit. And let me know, drop your thoughts below. Are you more cash heavy right now, or are you fully invested? Until next time, peace.